Night had settled over Arlington, Virginia. The city outside was quiet, but inside Argan Inc.'s gleaming glass headquarters, the lights refused to dim. Rows of monitors bathed the room in a cool blue glow, reflecting off metal glass and the eyes of the analysts staring at them. What they were watching wasn't a skyline, it was a web of numbers, and those numbers told a story that was beginning to sound off. Argan Inc., an American EPC holding company known for engineering, procurement, and construction of massive power and industrial infrastructure, has long been viewed as a model of precision. Through its subsidiaries, it builds power plants, refineries, and telecommunications networks across the United States and beyond. Its reputation is one of reliability, discipline, and technical excellence. But behind that steel facade, investors are starting to notice something that doesn't fit. The company's numbers are clean, its tone is calm, yet beneath that calmness lurks a subtle inconsistency, a quiet riddle that may redefine how investors perceive its true fundamentals. On January 31st, 2025, after the market closed, Argan released its official financial results. For fiscal year 2025, it reported approximately $870 million in consolidated revenue, $85 million in net income, and a backlog of roughly $1.4 billion. On paper, the performance looked impeccable. Profit margins were solid, the balance sheet lean, and debt almost non-existent. But within a few days, analysts and financial media began citing a different number. They reported Argan's backlog as somewhere between $1.9 and $2.0 billion. A $500 million difference had appeared out of nowhere. That gap, small in appearance but enormous in meaning, became the first major mystery surrounding Argan. Ordinarily, a company's backlog is calculated as of the fiscal year end and includes only contracts that are fully signed and approved for execution. Contracts signed afterward are typically recognized in the next reporting period. But Argan's reported backlog appeared to surge within mere weeks after its closing date. Why? Was it simply a matter of accounting timing? Or were some contracts already signed but still awaiting a notice to proceed, known in the industry as NTP, before they could be officially booked? In the EPC world, an NTP is crucial. It's the formal approval that authorizes a contractor to begin work and recognize revenue. A contract without an NTP, no matter how lucrative, is only a promise, not a project. So were analysts mistakenly counting those pre-NTP agreements as active contracts? Or had some institutional insiders seen documentation not yet disclosed publicly? Each explanation seems plausible, yet none are confirmed. That uncertainty, what lies in that $500 million limbo, has kept investors guessing ever since. Then, in early February 2025, a new announcement surfaced. Before the market opened, Argan subsidiary Gemma Power Systems revealed a major EPC contract to design and build a 1.2 gigawatt combined cycle power plant in Lee County, Texas. It was one of the largest projects in Argan's history, perfectly timed with the surge in demand from artificial intelligence data centers, which now consume vast amounts of power. The contract underscored Argan's continued dominance in natural gas generation, a field many had prematurely written off in the age of renewables. Later that month, on February 21st, Argan's telecommunications arm, SMC Infrastructure Solutions, announced after the market closed that Brian Orlandi had been appointed as its new CEO. Within a span of weeks, Argan had restructured leadership across multiple subsidiaries and secured one of its biggest power contracts ever. But there was a strange rhythm to these disclosures. Every major announcement came either before markets opened or after they closed, never during regular trading hours. For most public companies, important corporate news is timed for trading hours to allow transparent, real-time market reaction. But Argan consistently chose otherwise. Coincidence? Perhaps. Yet to some analysts, this recurring pattern looked intentional, almost as if the company was managing not just information, but sentiment itself. By timing announcements outside the trading day, Argan could release news in a controlled environment, minimizing short-term volatility and steering investor perception with precision. It's an unusual practice, and for a company built on timing and logistics, it might not be accidental. Behind those strategic disclosures lies the nature of Argan's business itself. The EPC model is both lucrative and perilous because it depends heavily on fixed-price contracts. In such agreements, the total project cost is determined upfront, Any cost increases, material shortages, or schedule delays must be absorbed by the contractor. To reduce risk, many firms use variable pricing or escalation clauses that adjust for inflation. Argan, however, has historically embraced the risk. Most of its contracts are fixed. That strategy can deliver exceptional profits when everything goes right. But when things go wrong, losses hit immediately and hard. Case in point, Argan's subsidiary Atlantic Projects recently reported losses from multiple projects in the United Kingdom and Northern Ireland. The disclosure was a single understated line in its report, but for investors attuned to risk, it spoke volumes. There was another issue: customer concentration. Argan's top 3 clients accounted for nearly half its total revenue. For most EPC firms, diversification is essential. No single project or client should dictate quarterly results. But at Argan, dependency is unusually high. That means one delayed project, one paused payment, or one renegotiated contract could ripple through the company's financials. Behind the impressive revenue growth lies a structural imbalance, steady on the surface but fragile underneath. Then came March 27, 2025. Once again, after market close, Argan reported quarterly results that exceeded every forecast. Revenue in the power industry services segment had climbed 65% year over year, and earnings per share hit an all-time high. Demand from AI and hyperscale data centers was fueling an EPC boom, and Argan seemed to be riding that wave better than anyone. But beneath the applause came another puzzle, the second major mystery. Even as global policy momentum shifted toward renewable energy, Argan remained heavily focused on natural gas-based combined cycle plants. Normally, EPC companies in this era are aggressively diversifying into solar farms, wind installations, and battery storage projects to align with energy transition trends and hedge against policy shifts. Argan, on the other hand, doubled down on gas. It's a surprising choice. Was it a calculated act of confidence? A bet that natural gas will remain indispensable as a baseload power source for AI data centers? Or was it an over-reliance on a legacy market, one that could turn against them with a single policy shift? Either way, the decision reveals a strategic anomaly that could define the company's future. To understand Argan's present, one must trace its history. Founded in 1961, Argan began as a modest holding company before expanding through acquisitions that built its modern portfolio. In 2003, it acquired SMC, entering the telecommunications infrastructure sector. In 2006, it added Gemma Power Systems, which became its revenue engine. By 2015, it had absorbed Atlantic Projects Company in May and the Roberts Company in December, expanding its industrial fabrication and construction capabilities. In August 2022, founder Rainer Bosselman retired and David Watson became CEO. And in March 2025, Argan relocated its headquarters from Rockville, Maryland to Arlington, Virginia, a symbolic move reflecting its transition from a traditional builder to a modern infrastructure power player. Every move has been deliberate, every change measured. Yet beneath that precision lies one question that haunts investors. Is Argan's growth in contracts outpacing the rate at which those contracts turn into cash? In EPC, the process from signing to payment is notoriously long. Contract award, NTP, procurement, construction, commissioning, final inspection, and ultimately payment. Revenue recognition is one thing. Actual cash flow is another. Recently, Argan's backlog growth has far exceeded its cash inflows. That mismatch could be a sign of strain, an early warning that some of those impressive numbers are more promise than profit. So in the end, the mystery comes down to a single question. When does the language of contracts become the language of cash? And when it does, how much profit will truly remain? The Valuester channel invites all listeners to share information about listed, unlisted, or pre-IPO stocks and coins that have caught your attention. Your insights could lead to the next financial mystery we uncover. Leave a comment below, tell us what companies intrigue you, and let's explore them together. To all our viewers who watch, subscribe, like, comment, and share these stories, thank you. Your engagement drives us to keep creating deeper, sharper, and more revealing content. This was Valuester.